Experts are worried that rising inflation could not only crash the party, maybe stick around for a long time. But not my next guest. He says there's no better hedge right now against risk than the Jays. Fed Chair Jerome Powell and Treasury Secretary Janet Yellen. For more, let's welcome in David Zervos. He's Chief Market Strategist at Jefferies. David, it's great to see you again. And I want you to come on for everybody right now. And this includes everyone, maybe from some folks buying crypto to Larry Lindsay yesterday, who laid out a strong case for why he's concerned about budget deficits and persistent inflation. Why don't you agree? I mean, here, most people would say, yeah, of course the 10-year should be at 3%. Would you agree with that or no? Do you think that even that is unlikely?
No, I don't agree with that. I mean, I think there's a chance with some of these base effects and a few of the short-term reopening issues that we could get a pop in inflation. We're going to get that base effect pop. I mean, the comps, remember, we're comparing to March, April, May. When the economy collapsed, we lost 22 million jobs, prices collapsed, activity collapsed, and now we're going to lose those pieces of March, April, May. So the comps are going to look amazing against such a terrible backdrop. And that's both for inflation and for things like retail sales like last week and other economic activity indicators. So you're going to get this, and then it's going to roll out, Kelly. And then we're going to be back to where we were, which is, back in January, February of 2020, we had a 3.5% unemployment rate. There were 8.5 million people more employed, and we still couldn't hit the Fed's inflation target. We were running below 1.5%, and we had been for over 8 years. We've been missing the target by something like 60 to 70 basis points a year since 2012. So I just don't understand why everybody, I do understand it. People love it because it's a good story. It's not a good story to say, hey, inflation's going to probably be benign because of technology and demographics and excess debt levels, which is pretty much, I think, the case.
Well, and I'm sitting here saying I could totally see your argument and I totally see the other case. And that's what I find so interesting about this is I can see why you're saying that we haven't hit the target and we could have a much bigger labor force. And the thing is, if we do have a bigger labor force, it's probably going to be a much better outcome, right? For so many reasons, including it mitigates, supply shortages and wage hikes and all of that. But what if we don't? I mean, what if there's a scenario? I think that's partly what some like Larry Lindsay would say is that we're not going to get labor force going back up. We're going to get big wage pressures. These cost pressures will be persistent. Housing keeps going up. Even the imputed rent from that continues to contribute. I mean, could this, even if it's lasting, still stick around with us for several years' time?
Well, what's really interesting, Kelly, is actually low labor force growth rates, as labor forces tend to contract in places like Japan, Scandinavia, Northern Europe, and also here and eventually in China. Those are the demographics. We see demand go down. It doesn't, we don't get the worker shortages because you only hire someone if you can sell the product that you're making. You need the demand to get there. And a fast growing labor force, like what we had in the 70s with baby boomers coming in and no one really leaving, that was in the same category of size as baby boomers, we just saw a huge demand increase. So I don't worry about the shortage of workers story. And I'll tell you the other interesting thing, and I think about this a lot. You have a lot of CEOs coming on here talking about how the pandemic has changed their business, how technology's changed their business. I worry that a lot of the technological advances that were going to take place over the next decade all started to take place much faster in the response to the pandemic. And that as they go to look at hiring back who they need, those companies that had an internet strategy, that had a tech strategy are the ones that survived. They're going to plow more into that. And they're just not going to need the same amount of workforce as they had before. So we're going to get a lot of retail and a lot of hospitality jobs back in the next few months. That 8.5 million goes down to 654. But that 4 million down to zero, back to where we were, that might be a harder thing to get done in the second half of the year. And I don't think people are thinking about it that way. They're extrapolating these sort of these trends of like, millions of jobs a month. I don't buy that.
Shepard Smith here. Thanks for watching CNBC on YouTube.